Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled that you're here. And I know you're going to get tremendous value from the gentleman I'm interviewing today. His name is Drew Breneman. He actually has his own podcast, by the way. You should check it out. It's called the Brennaman Blueprint. Now, his name is spelled Breneman. Of course, that'll be in the show notes. But let's see. Drew started his real estate career when he was 19. He has, and now he's got $200 million in assets in, I think, 2 or 3 primary markets. We'll dig into all of that. But we're going to have a lot of fun today. It's going to be a real wide-ranging conversation. Drew, welcome to the show, brother.
Yeah, appreciate you having me on. Thanks, Rod.
Absolutely, for sure. And I know I'm getting interviewed on your show in short order as well, so that'll be a lot of fun. I'm looking forward to that. But why don't we start as we always do and just have you talk about, your story, your journey, and kind of bring us from where you started, why real estate, maybe what you did before real estate to present day.
Yeah, well, so really, I started really young in terms of getting into real estate, where I was fortunate in that I started an internet business in high school. Some of my friends were selling items in these video games they were playing on the computer. I saw what they were doing and I thought, well, I don't really care about playing this game, but I see you guys are all making money selling your stuff when you're done. So I saw stuff on eBay selling for like armor sets and whatnot and swords and shields for this game. Sometimes it would sell for $10, sometimes it would sell for $20, all over the board. So I started thinking, hey, why don't I throw in some money on this, see if I can buy low, sell high with the items. It worked out. And just from like sophomore year of high school, call it to freshman year of college, I did thousands of transactions. Just every day I'd come home from school, I'd have like 20 or 30 purchases on eBay or on my website. I'd make the deliveries and then I'd do my homework. I'd go to bed. It just rinse and repeat. And, in about a 4-year period, I made between $80,000 and $100,000 of money. And I wanted to start, figuring out what should I do with this. My parents, they're both teachers, so they weren't like big spenders. So saving money and investing was something that they taught me, as well as like a lot of other really good lessons. But that was something they had I just observed from them. So I didn't start spending the money. I didn't buy a better car. I just saved it all. And why I said I was fortunate was, I started reading the books that most people read probably when they're 40, like Rich Dad, Poor Dad, Intelligent Investor. I did a book report on Think and Grow Rich, and like the light bulb for real estate really went off for me. I was reading Invested in Real Estate by Gary Eldred, and he had just a really simple example. I'm brand new to hearing about real estate. He's talking about cash flow, paying your loan down, tax breaks, things that were, I could understand, but it's hard to tell what would the returns be. And he had an example where, this is like in 2002, I'm probably reading this book, and you put 10% down on this house. In his example, every year homes had gone up like 3% or more, the last like 50 years at that point. And if your duplex, your house, whatever your rental property is, goes up 3% and you put 10% down, that's a 30% return in a year. And the light bulb really went off for me reading that. I still remember I was outside like on this deck we had with like one of those like wooden swings reading this book. I'm like, shoot, this makes a lot of sense. I'm gonna dig into this.
And one of my questions is, have you had any epiphanies? So that was definitely an epiphany for you. And that's a very interesting way to describe what you just described as far as return based on appreciation, organic appreciation. So please continue. Sorry I interrupted.
Yeah. And of course, as you do this more, you realize, most deals you're not putting down 10% and, 3% return isn't just like clockwork, like in this super simple example, but got the real estate bug going in me. And I had also tried to invest in the stock market, mutual funds, other things, but I was just like too young, honestly, for those. I was, 17 years old. I'd buy a stock for literally a day. And then it would go down and I'd be like, I think I need to sell it. Like, this isn't working out, so obviously now being older, like I learned like you're way better off, thinking long-term, investing long-term than something like that. But yeah, so then I'm from the Milwaukee area, and I was going to go to UW Madison in Madison, Wisconsin for college, regardless of real estate or not. So I decided once I was, I'm going to go to Madison and I'm going to buy a deal when I'm a freshman. So you have to live in the dorms. It's required there. And then my plan was I'll buy a rental property that I'll live in my sophomore year, and then I'll rent out the other units if there's other units. And this was in like 2004, so it was really competitive, the housing market. The first property I went to, there was literally a line out the door for a deal to get in it. They priced it below market value, to get a bidding war going, and strategy worked. And that one I didn't get, but eventually I was able to buy a duplex for $220,000, put 15% down on that, and then was able to qualify for the loan because I had this business income on my tax return from high school. And in school I did 3 more deals, so bought four properties total. Had sort of invested all my money, and then thought, what should I do next? And I could see the housing market, everything was slowing. I graduated December 2007. So I thought this would be a really good time to learn. So I got an internship at an office developer, a full-time job at a multifamily developer, and then switched to a different full-time job at a retail company. So I got a lot of exposure quickly to a bunch of different product types. And while I was working at the apartment developer, I met my first real investor partner. So it was a father and a son. The son was an intern where I was working. And he had, I told him what I was doing, and he was like, why don't you go talk to my dad? And we meet with him, I think we met like literally the next day. Like, I don't like to waste time. So I was like, let's go meet with them for lunch. I printed out a bunch of deals, and I had no idea what they would be interested in investing. Because again, with parents as teachers, maybe I'm thinking they probably want to buy like a duplex or something. I'm not thinking I'm meeting with somebody who could buy like a $3 million deal, and they could. So I met with them, and they really liked the $3 million shopping center that I had printed off in that meeting. And that was and we ended up buying that deal. So that was in 2009. And from 2009 to 2012, the 3 of us, we bought commercial deals. This was up in Minnesota. We were buying, really like a lesson there was, how strong multifamily is, because we were trying to find multifamily deals, but no one was really selling. They were saying these deals are still operating well. I have, probably a loan from Fannie or Freddie. I don't need to sell it. And they kept it. Whereas all these commercial deals, we were buying from developers who maybe had, 10 or 20 deals, and they were all screwed up, every one of them, except for maybe like one. That was
when you say commercial, sorry.
Oh, yeah.
When you say commercial, was it all retail at that point, or what was it? I assume
retail, industrial, and office. So out of those first 6 deals, 4 were retail, 1 was industrial, 1 was office. Really what we were targeting at that point is we were trying to be we knew the Twin Cities, we knew what the good areas were, and then we knew how all these product types worked, but I wouldn't say we were like an expert in any one of them. Sure, and that's something that I
couldn't be, right? And that's short.
Yeah,
time.
so
I'm sorry, let me ask you let me just make one comment. I mean, your timing was impeccable because, in 2009 to 2012, good God, if I hadn't been hiding under a rock, I'd be on the back of a yacht. So, you're good for you. But anyway, please continue.
Yeah, and it's interesting, at the time, it did not feel like that. Everyone thought we were crazy to be purchasing property. Right. It's not too dissimilar from today in a way where, prices have pulled back, rents have stopped growing on a lot of assets, and it's hard to make sense of deals right now where you're buying at a 5-something cap probably on multifamily, or borrowing in the 5s. You're not getting like a spread, and for that, so it was back then it was a little different. It was like we were buying our second deal we bought as a shopping center, and we were literally watching CNBC wondering if Wells Fargo was going to go out of business. They were on our end cap, and they were like the next bank up to maybe go under.
Sure.
And
for sure.
Wells Fargo didn't go under.
That's a timely comment as well, right? I mean, I don't know if you just saw the Jamie Dimon's comment about bank failures. What is today? What is April 5th today? April 4th?
Yeah.
April 5th? Yeah, April 5th. And Jamie Dimon just literally in Fox News today talking about, that these bank failures are going to continue. And I saw someone else that, regionally, that there could be a lot of regional banks in trouble because of this commercial debt, especially in the office environment. I mean, they're getting killed in the office environments. Do you still have office buildings?
We don't. We still have the one industrial deal, and then a lot of the retail deals where that's actually been a good product type still, the small shop retail, where we're not buying like the big box stuff that's closing, but small shop retail where our tenants are like Verizon Wireless, Panda Express, Panera. We got two of those.
How did you fare through COVID? Because I know I have friends in retail that really got their asses handed to them when COVID hit because they're
we had to work out a lot of deals, but just deferrals. So meaning you can't pay your April and May rent supposedly. That's fine. We'll pay that in November and December, and then. But we didn't forgive any rent, and most of the tenants, and what I kept telling them was like, you guys are all a way bigger company than us. Like all these most of these companies, you're public. You have, I mean, this is Sleep Number and just big companies where you guys are nationwide and public. Like we tried to play the little guy in that conversation. We're just 2 or 3 guys here, with the couple properties. Like we're impacted too by this. No one's letting us defer our mortgage payment or property taxes or anything. So we're in the same position as you guys. So we can't really do that much for you.
No, that was a great strategy. And I'll tell you, I want to circle back to something you said, which is real timely as well. And really, I felt it in the crash of 08 and 9. I lost my ass because of single family. I had 800 houses, and those are what pulled me under, but my apartment complexes did just fine. And I do believe we're going to see opportunity in the multifamily space, and I'd love to talk to you about that, particularly in the bridge debt environment. A lot of people did bridge debt, but
I agree with that. If you just want to go there now, like I agree with you, where there's been a bunch of in a lot of these markets, especially in the Sun Belt. We buy in Phoenix, and it feels like every deal in Phoenix is sold in the last 3 years, at least once. And a lot of those buyers, right, in order to get the leverage they needed to hit returns, they were doing these, debt fund loans, which were variable rate loans, floating rate. The lender makes you buy an interest rate cap. Term. Yeah, right. It's a 3-year loan, and then they make you buy a 2 or 3 year interest rate cap. Well, yeah, everyone who bought in 2020, let's say, they're okay because prices went up a lot, so did rents. But as you get further into, the end of 2021, 2022, rents and prices haven't moved up that much since then. And if you bought a 2-year rate cap, that's coming up, maybe towards the end of this year, where you're going to have to pony up a lot of money to buy another rate cap. And if you want to refi, you're doing a cash in refi because your rate, with where your cap was, you were sized at like a 4% rate probably, and rates are 5% plus now. It's a big difference on these apartment deals.
Yeah, just read they're gonna bump. The Fed's gonna bump another 0.25% is anticipated in May, although it doesn't directly correlate to commercial debt, but it's still onerous and
it is. And the Fed funds rate is correlated pretty much 1-to-1 with the SOFR rate, which is what all these floating rate loans are based on. But it's not like you're saying.
No, you're right. On that particular in that particular environment, you're absolutely right. I was.
But what you're talking about wasn't that. It was a long, like a 5-year or 10-year fix. Those are priced on the 5 and 10-year treasuries plus a spread, and those aren't that correlated with
no.
With the Fed funds, more correlated with where the economy's at and other investments.
Right. And, let's talk economically. I mean, let's just go there right now because you're very knowledgeable as well. So, I don't know about you, but I'm pretty bearish right now. I mean, like McDonald's just talked about layoffs. Jamie Dimon is pretty aggressively, this ahead of Chase, guys, if you don't know who that is. And he's pretty, and he was quoted 4 months ago saying that this thing was going to be severe. What are your thoughts, just in general, economically?
I think that in terms of the economy, I think there's the pain hasn't really hit Main Street. For us, we feel like it has, but that's because we're in an industry where it's capital intensive and we're all borrowing a lot of money. So you increase interest rates, that has a big difference. But for us, your average person, I mean, that's really only impacted them if they, needed to buy a car or something and borrow money. So like that, it hasn't really trickled, I don't think, these Fed funds hikes through the whole economy yet. And when inflation actually does slow for real, and that's felt on Main Street, like that's just going to make more people pull back, spend less, and it's going to keep, kind of keep happening and slow down the whole economy. So I still think there's more pain to go. A lot of people who are, in these apartment deals that are very sophisticated, their first question is, give me a rent roll that shows the delinquencies, because you're starting to see that trickle up now, and especially in the, the Class C and B properties.
Yeah, that's why we don't do C Class anymore. I'm for the short, in at least through this period of time, it's a flight to quality, because that demographic's getting killed.
That's the same thing I've been saying. I think you're spot on, where you right now is the time, if you're going to buy a deal, you want to trade up in quality. That's I absolutely want to do. You got to push your hold period out. Like, now is a bad time to try to do like a 3-year hold on a deal.
Hey, 10-year debt, man. That's all I'm doing.
Yeah.
Is to, guys, in the commercial real estate world, it's not like residential where you can get a 30-year loan. Yes, you can get a 30-year loan or amortization, but you're going to have a term. It's really what you might know as a balloon if you're in the single family space. And a lot of these guys, these last couple of years, like Drew was just saying, to get the returns they needed, they got bridge debt, this very onerous debt, and they're going to have some problems. In fact, I'll give you an example of this, Drew. We were looking at a deal in San Antonio, and the reserve payment to get this guy ready for his loan coming due went from $8,000 a month to $80,000 a month. This is real small.
To buy like a cap, an interest rate cap, or why was it jumping up?
I don't know the detail.
Oh, okay.
I just know that it was killing this guy, and the deal didn't make any sense. It was too small for us. But even one of my ex-partners has some bridge debt, and there's been some talk that he's going to have to throw $2 million in to satisfy. Actually, no, that's right. When I spoke to him recently, it's been dropped to $1 million, but it's still significant.
Yeah,
to weather the storm, and a lot of people don't have pockets like that, that can do it. So I think there's going to be some opportunity there. I hope there is, because I'm kind of excited. It's been kind of brutal finding super deals these last couple of years, but so we'll see. And the other thing while we're talking about it is, if the office environment. And I was just reading this today in the news. If the pullback, because even the government employees, that's right. The article I was reading today was about government employees. They're the largest office renter in the country, and
I believe
a lot of the government employees don't want to go back to work. They want to work from home. I mean, don't get me started on that group, but and the experience I've had there. But if they're going to reduce their office footprint, that's huge. And a lot of that debt is with regional banks. And so, it's kind of scary, honestly, because if that implodes, how does that, there's so many potential catalysts, the Ukraine thing, the inflation, the bank failures, if that expands or gets worse. So, It's a little tenuous. I'm my mastermind. I host a mastermind, some of the largest multifamily operators really on the planet. There's about $16 billion in assets in there. We're actually meeting in 2 weeks in Dallas, and I think that's going to be a huge topic of conversation. Is how we weather the storm, and we're going to focus on asset management, property management. These are some of the topics we're going to really drill down on, because that's what's critical in an environment like this. Right? You agree?
Yeah, it is, where, your prices aren't going up on their own anymore, and neither are rents really. So you actually, it's kind of back to the fundamentals, where actually operating these properties well is going to matter.
Yeah.
So definitely
there are a lot of new operators that, entered into the marketplace in the last 3 or 4 years or 5 years, 6 years, never been through a downturn. And, I think that's going to play out as well, in vacancy and challenges. Well, anyway, so why did you shift over into multifamily from your small duplexes and things like that? Why'd you start doing larger deals?
Yeah, well, really, so I had invested what money I could, and then I was able to sort of make my own luck and form this partnership, if you will, where I got into bigger deals. And we started, as we were doing the commercial deals, we saw some things we liked about them. So this is, retail, office, industrial, but then a lot of things we didn't. You lose a tenant and it takes a long time to re-rent it. It's very expensive, where it's shocking when I explain, if you would say like per foot, what is it in retail for with your vacancy and everything to re-rent a space? Because we still do look at mixed use properties, and some of the guys who work for me, they've really only bought apartments, and it's like, what should I plug in here on like an assumption if they leave? And you could be at $100 a foot pretty fast on what you would spend in terms of missing out on a year of gross rent. That could be 30, 40 bucks fast. Then you got to pay your broker, the other broker, give them a tenant allowance, 20, 25 bucks of free rent. It added up fast. And so meanwhile, I had these apartment deals on my own still. And every year, it's like the rents were going up. It's consistent. And I have an interesting story on the long term too with the apartments, where the last deal I bought in Madison, I bought in 2007, just at the total peak for prices. And I was thinking about selling in 2009, and it wouldn't be too different than the story you're saying, where if my loan came due, I would have had to add money or just sell it and walk away with nothing. And I was thinking about selling it, and because at this point I was living in Illinois, managing it from like 3 hours away. But what happened was I kept it. It was a 10-year, it was a 30-year amortizing loan like you're talking about, but it had a 10-year term, and it went floating rate after the first 5 years. I remember thinking like, geez, this rate's going to explode up. I'm going to be screwed here. Anyways, long story short, I stick in the deal. I paid $700,000 when I bought it in 2007. And in 2017, I sold it for $1.22 million. So staying in it was a big thing. So I think a big part, just to, as you were talking about the opportunities, like if you're in any of these deals, you really are going to want to not give them up, do anything you can to stay in them. Like that friend of yours, he's going to need to just add the $1 million. Think of it as, I'm just paying my loan down. It's not like I'm losing the money. It's, I'm just deleveraging, and he's got to stay in that deal. If he sells now, he's selling at, arguably the worst time to be a seller in terms of price.
No question.
So
no question. This is the worst time to sell for sure. So, and we're going to be waiting not for the owners that want to sell. We're going to be waiting for the ones that have to sell, that need to sell. And so, you had sent over some thoughts that we could talk about before we met here. And one of the things you mentioned was tech. So maybe you could expand on how you've utilized technology to maximize either your research, your operations, your effectiveness, whatever. So if you'd expand on that.
Because so one thing too, just to kind of bring it to current day. So from when I started to about 2019, it was just me and my partner buying deals and just doing our thing, doing every piece of it. And actually in 2019, he passed away just unexpectedly. Oh. So then I had to make a total pivot where then, now it's just me and the dad, and those deals where we still have them, but he's not really that interested in a bunch of like new stuff or, right. So what I wanted to do is like kind of expand into, we all made a lot of money together, the three of us, but we're offered, I see people doing syndications and, kind of spreading this around. I want to do the same thing and have just, because I'd have people come up to me where they would want to invest, $100,000 or something, or not come up to me, people I knew. And we weren't really set up to do that. It's like, we're just set up for one investor. And that's it. And so what I wanted to do is have like, be able to pool a bunch of investors together. And sort of the first change we had to make with that was, you need a lot more infrastructure to have a bunch of investors versus just one. We needed no infrastructure almost, because it was like our investor's daughter did the accounting, his son's in the deals, and then it was me. Where now, if you're gonna have a bunch of investors, you need a platform to manage them. So we signed up for Juniper Square, which is an investor portal.
Super expensive. I'm surprised you went right to the top. That's probably the most expensive portal out there, I think. And let me expand on what you just said, if you don't mind, just clarify for those that don't know what you're talking about. So guys, when you do syndications and you start taking money from investors, you absolutely need a portal. And there are lots of them out there. We use Cashflow Portal, love them. We've used actually 3 so far in our evolution. And what that does is it allows you to effectively manage their money. It comes in, it's allocated properly. It helps you distribute K1s and communicate with your investors and present deals to your investors properly, and on and on and on. And so okay, so back to your story. And so the one he's describing, Juniper Square, like I believe, is if it's not the most, it's really close to the most. So
yeah, and it's. I mean, I went all in on setting this up. I mean, right now in total, we're spending like $50,000 a month between the 4 or 5 employees I have and all the different software and tech we have. But it's,
wow.
But the idea is,
I'm kind of surprised by that. I have to tell you and I was going to interrupt you earlier when you said that you needed a team to start raising money, and I was going to push back on you a little bit because I think with the tech you can minimize.
Agreed with that.
Okay.
But we're trying to do it at a bigger scale. Where in our first, from when we really started spinning up at the end of 2021 to then May 2022, and then with the market change, we stopped. I mean, we bought, $50-60 million of deals like pretty easily in terms of the effort that was involved, and so we were really sort of scaling that up. We had another deal for $30 million under contract. And all these deals require a lot of work because what we're buying at that point were usually like a Class B deal in Phoenix that needed a pretty big renovation. So you started stringing together a few of these and you look at it, you're like, wow, we're doing, each deal is like $3 million of renovations basically. So 3, 6, 9, you end up needing a lot of, there's a lot of things to work on. And then,
you got to raise. Did you raise that money, or did you come out of pocket for the capex? I mean, did you raise the capex?
We raised it, but just in terms of implementing it, we're responsible to oversee the renovation and stick to this business plan. And then that's a full-time job, running 1 or 2 of those just from the asset management level. So
did you have a third-party property management company involved? Were you using their infrastructure? Okay.
Yeah, we are. I think that's the best way to enter a new market is with a third-party manager, see what they're doing, learn the laws, see what vendors they're using. But if you can bring it in-house, I think that's better. I've been...
No question. Yeah. But back to what you just said. If you're doing a big renovation, yes, you've got to have eyes on it. But like, for example, we've got someone supervising an asset that we're renovating, and it's a huge. I mean, it's about $4 million in Nashville, and basically we have weekly calls, and again we're paying for some supervision there through the management company's construction division. It's going really well. They're on budget and everything else, but. I mean, it's not like consuming. So I don't know if you do it differently or if you're actually there on site for the entire thing. Or
I know what you're saying, and they're also pitching in on the other. Like I'm in I think 28 or 29 deals, to get to that 200 some million where so there's work that comes up on those obviously, and then they're pitching in where one of them does asset management, and then we're doing 30 tax returns and quarterly reporting, monthly distribution, where there's just a lot of work that comes up. I agree with you.
Team. What pieces do you have? What roles do you have in your team now?
Yeah, I have 2 asset managers and 2 acquisitions people, and I think that's most important. I think when you're starting out hiring is sort of making sure you can take care of I'll call it like the day-to-day. So I think if you were going to be if you're building this from scratch, like I think asset manager is the first hire, assuming you have your accounting taken care of. And we have a third-party CPA, a woman that we pay hourly to do all of our accounting, who's like amazing. And so we have our accounting already handled outside. But then, 2 asset managers, and then one of them is, he's the person who's the best with Juniper Square and handling all the tax returns and everything with investors, getting all the docs signed. And then the other asset manager is really more driving the business deal. So when you're talking about the Nashville deal, I mean, someone, in my opinion, on a deal like that, they need to be pushing the business plan along, where the third-party manager, they're very reactive, and we want to be proactive in pushing them along. So I'm sure there's someone in your partnership who's doing that. And then that's like a cost that, we bear. We charge a construction management fee, and an asset management fee. So like those fees then come in to pay for these people. So it makes sense in terms of the economics for everybody, but you need someone to drive the business plan along. I think that's like a common let's say beginning investor mistake, just to mention that, where when I went from self-managing all my deals, and then I had relocated to Minnesota, I hired a third-party manager in Madison. I thought I'd be doing nothing. I'd be there, just handle it. And I felt like I did the same amount of work because you need to really drive them. Who's setting the rents? Who's arguing about this $700 repair bill that you thought should have been $300? Like, you're doing just as much work. It seemed like it's just different work where you're not getting called at 11 o'clock at night on a Saturday anymore, but you're still heavily involved.
When I do my boot camps, I do boot camps, 2 and 3 day boot camps. In fact, I've got one coming up May 6th and 7th, the virtual one. But when I do those, one of the things I tell people is, once you hire a third-party property management, it's not like you raise your hands like you just lassoed the calf and you're off to you're off. You're literally, you've got to manage that asset. You got to manage the managers, just like you described, right. and your work's just starting. In fact, when we carve up a partnership, a general partnership, and a syndication, the asset management chunk is the biggest chunk because it goes for years. And so
I can see that.
Yeah, for sure. So
I can keep going on the tech if you want. I didn't.
Yeah, that's where I was going to. I was going to ask where I was going next. Yeah, please do.
So where I ended up hiring someone who used to work at a $50 billion private equity place, and during COVID, he saw the model they were using to underwrite their deals, and he was like, you know what, I could make a better one, and he did. And he ended up interviewing for me. I hired him. And now that's our model as well, and we've improved it a lot. So we have just an insane underwriting model where we pull in all the information, we clean it in it's an online, I guess we'll call it, program or software called RdK, where you can reorganize all the rent rolls, T12s, and then it flows freely through the model. You input it, and then it basically fills out the rest of the model. You just change a couple, the most important key assumptions, really, and then it's. So like we have an insane model, and then the same guy's into sports analytics. So he made a predictive market model for multifamily price appreciation.
Let me stop.
Yeah.
Let me stop you just for a second because so it's kind of funny. That parallels exactly what we just did in my company. I had somebody who was 20 years with Intel, and he did an analysis model for us, which is insane. It's so good, and we give it to my students, my warriors, and it does everything you just described. And it's so important because, and it's got 2 levels. It's got kind of a preliminary level, so you can do really quick reviews, although it's very detailed, but then there's a real advanced level, which goes to a whole nother level. But I want to hear about the predictive. That's fascinating. Please continue on that thought. Yeah.
Because one thing that I had realized sort of when I was sort of reassessing what I was doing in, 2020 with my partner passing away is just, we were doing really good deals in Chicago. I think our average return was like a 25% IRR and the stuff we sold. But there's a lot of headwinds in Chicago. Like you see people in Florida and Phoenix.
Let's not go down that rabbit hole. But I could absolutely comment on that. But you guys just had a new mayor elected yesterday, I think, or the day before.
Yeah, and everybody in the business and community and people who care about public safety are really disappointed with that outcome. And I think that, but so there's so many headwinds here. And so when he started working for me, one of the things we wanted to figure out is one thing Barry Stern always says, who's, Starwood Capital, that's someone that if people listening haven't ever heard of him, he's got so many really good interviews on YouTube. He's not doesn't have any sort of media that he puts out. These are just, he goes on Bloomberg and just starts dropping really great advice, or does a interview for a college. Anyways, one thing he always says is you want to get in front of the freight trains in your life and follow trends. Get in front of the trends is what he always says. And I mean, I'm investing in the Midwest, and the trends are not in our favor. And so we want to figure out what is the best thing moving forward. And for a hobby, what he does is the guy who works for me, Evan, he does sports analytics. So he made a predictive, we'll call it NCAA bracket optimization model for fun for the NCAA tournament. And so he applied all that to go, I'll pull in all the data. We'll look at the top 37 markets in the country, and we'll find out what's actually predictive and drives the price appreciation of multifamily. And if people want to know, number one, in terms of what was predictive and correlated with appreciation, was population growth as a percentage. So not just raw numbers, because one thing that drives me crazy is people will be like, there's whatever, how many people a day move into, let's say, Florida. And it's like, that doesn't tell me anything without like the percentage or what's the net number too. Like it's not,
Sure.
what people are moving out, but, and then job growth as a percentage and then rent growth as a percentage. Then we figured out what wasn't correlated, and then that told us what are the top markets. And in our model, the number one market in the country is Tampa. This is just for price appreciation. Number two,
that's my backyard, man. I could totally agree with that one. We saw 34% rent growth last year. It was insane. So
love it. And then number two was Phoenix. So we saw that, and then we went all in on Phoenix because Phoenix has the best property tax laws in the country. They have this thing there called Rule A or Rule B, where what they do is they don't change your assessment by more than 5% increase per year, even if the property is sold. So you have really a lot of tax certainty, which then you have really high rent growth as well, but your expenses are not growing as fast as the other top markets, like in Florida, like in Texas. Sure. So
taxes are your biggest expense, guys, just so you know. I mean, that really, so that's huge for sure.
Yeah, and then in all the other top markets too. So then, the next ones up were, I think Orlando was number 3, then 4 was Dallas, 5 was Austin, and we also then looked at how the markets were correlated too. That was something he knew how to do with how the prices moved, and Tampa and Phoenix are really correlated, and so was, I think, Orlando.
When you say correlated, expand on what you mean by that.
Yeah, so let's say a correlation of 1.0, so like 1-to-1 means they would move exactly the same in the same direction.
Oh, gotcha. Okay, so you're just correlating. You're correlating the growth and the metrics that you're comparing in each location.
Like if you put like a chart of like Tampa next to Phoenix, it would look very similar in terms of what they do.
Got it.
Whereas you put a chart up of Dallas, and it would look very different than those ones. And so then we wanted to start picking markets based on how they also interact. Like one thing then why we're starting to get going in Dallas, and because of the reason is, like in the last downturn, 2009, 2010, for the entire Sun Belt and all these growth markets, it was the most resilient. Like the prices barely went down in apartments, and in single family, they went down less than 10%. And if you compare that to Phoenix or what happened, in Vegas or Florida, these places where they went down 30+%.
Oh, more than that, brother. More than that, buddy. 50% in my portfolio, even more than 50%. But no,
I was trying to be nice.
And I'll tell you, we got. It's okay. I love Florida. I could be a poster child for Florida Chamber of Commerce. Don't worry, you're not going to hurt my feelings. I
see you on the beach on social media.
That's right.
So.
That's right. Yeah, but we've got, I don't know, probably close to 2,000 doors in Dallas. I love the Dallas market, and we've got assets in San Antonio and Houston as well. I love Texas in general. Austin, haven't gone there. Just been too expensive. I'm not sure I love the politics there either, the local politics, but we won't go down that rabbit hole either. But anyway, let me add a couple things. On our end, on the tech side, we use Microsoft Teams now. We were using Slack, which is a painful migration, but we're totally going over to Teams now. We use Asana for our project management and HubSpot for our CRM. And for those of you, if you're interested, HubSpot has a free version, highly recommended. We spend several thousand a month on it, but
and do you use HubSpot for all your businesses, for all the email stuff too as well, or you're talking about the CRM?
Yes, both for my thought leadership platform and for my acquisitions business, we use HubSpot. And it's going really well. We've got a really nice deal process flow in Asana. In the different stages of a deal, from LOI, whisper price, all the way through to closing and asset management. But
nice.
Well, listen, we're bumping up against the time here. Was there anything that you'd like to add that we haven't discussed? I think we could probably keep going, but
I think kind of like no, I think we covered a lot, but I think if people too, we just kind of talked a lot about what I'm doing. I think probably lessons people could pull out, from this. Like it's a lot of this stuff. It sounds maybe easy now in retrospect that we did all this, but a lot of it was just, we thought long-term, we weren't doing short holds. We weren't, it was just sort of, and also just creating your own luck where so I met this, this coworker of mine, but he also went to UW Madison. There's thousands of students there, and we worked at a pretty big apartment company, but I was doing something, they saw that, and then they liked it. So I think one thing where I know you have your Warriors program and all the events, and I think one thing I like to hear you talk about is you're really pushing people to actually like to do something, where they take action, where it's not like there's not this 50 courses to sign up for. Well, and they got another thing and another thing and another thing. Like you should learn for, call it 3 months or 6 months or something, and then you got to take action. So we didn't really get into that.
Massive freaking action, bottom line. And of course, my whole platform is centered around mindset. I mean, there's a reason my students own upwards of 150,000 doors that I know of. I think it's more than that. And, and I've only been teaching for 5 years, something I'm super proud of. And it's because they take action with what they learn, and because I'm pushing them. I'm in their ear every day, go make it happen. And so, I think action is the biggest piece. I'm really glad you brought that up. Action mitigates fear. And I tell my students, get out there and just keep taking action. You're going to make mistakes, and that's okay. But that's what it takes. It's not the knowledge. And of course, it's the connections as well. My most successful students are the ones that are most connected inside of our environment, because it is a team sport, and they get together, they do deals together, and it's just extraordinary. But, well, I really appreciate you coming on the show, brother. I think
thanks so much.
We'll need to have you back on in, say, a year or so, see where you're at that point, because you added a tremendous amount of value, and I appreciate it.
Yeah, happy to do it. Thanks for having me.
All right, buddy. Talk soon. See ya.
So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. But see, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now, again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.